Surfactants Limited Q3 and 9M FY22 Earnings Conference Call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Unithan Shekhar, Promoter and Managing Director, Galaxy Surfactants Limited. Thank you, and over to you, sir.
Thank you. Ladies and gentlemen, a very good afternoon to all of you. I'm delighted to welcome you all to this first earnings conference call of the year 2022. Let me take this opportunity to wish you all a very happy and a prosperous year ahead and a healthy year ahead. Hope the year 2022 brings success, good health and fortune for all of us. Before we dwell into details, I would like to remember author Charles F. Glassman's famous quote, "Short-term pain leads to long-term gain." This quarter required your company to take certain quick and strategic decisions. The decision to either go for short-term gains or take the pain but ensure steady long-term gains. We chose the latter. In a quarter marked by significant volatility on account of rising feedstock prices, supply chain constraints, we had the option to either declare force majeure and not clear the pending backlog of previous quarters or service our customers first. Rising feedstock prices and freight rates meant we had to choose between rediscussing the concluded contracts which constitute nearly 60% of our business and seek price hikes or take the short-term pain and seek the increase in the coming quarter. In line with Galaxy's motto of customer first and considering the long-term strategic relationships that we have built over the years with our customers, fulfilling our commitments made to them was our first priority. By sacrificing the short-term gains, we believe we are fortifying our long-term goals. Yes, we do agree this did impact our performance in the quarter 3, but I'm pleased to share the qualitative gains we have made with all our customers on account of this that will yield significant fruits going ahead. It gives me immense pleasure to share with you that all our key customers have acknowledged and appreciated our commitment. We therefore believe this quarter in turn has laid the foundation for our next decade of growth. As they say, without commitment you cannot have depth in anything, whether it is a relationship or a business. Coming to the business performance, the scenario in this quarter was like that of the previous one. Supply-led volatility continued in the quarter 3. The sudden surge in prices of fatty alcohol, crude and freight rates, especially in the developed markets in the October-November vis-a-vis September, accentuated the situation. While volumes have remained flat year on year, the decline in EBITDA per metric ton impacted our overall performance significantly. Both these factors need to be understood in the global context. Crude derivatives, fatty alcohol and fatty acids constitute nearly 80% of our raw material buying. Compared to September, each of these rallied anywhere between 10 to 47% in the October-December quarter. Given that bulk of our business are contractual by nature, the pricing mechanism in place will ensure that these incremental costs get passed on with a lag of 1 quarter. While specialty products and the rest of world markets reported a growth, the sudden surge in freight rates to Europe and USA, along with unavailability of containers, adversely impacted margins. A significant share of specialty business is contractual with a quarterly lag. Nearly one-third of our specialty business in US and the European Union are DDP transactions. Unavailability of trucks along with port congestion issues led to additional detention charges, which further dented margins. Export incentives realized in Egypt in Q3 FY21 to the tune of rupees 14 crores was not realized in the current quarter. The decision to honor our contractual commitments in choosing short-term pain over short-term price hikes or force majeure adversely impacted our EBITDA by approximately 5 crores. This quarter also saw your company moving towards natural gas instead of coal at our Tarapur plant. This again was a move made in keeping in mind our long-term sustainability goals despite the high natural gas prices. This so adversely impacted our EBITDA for this quarter by approximately 2 crores of rupees. While raw material availability improved in this quarter vis-a-vis Q2, container availability resulted in delayed shipments, which resulted in loss of volumes compared to the previous year in our major surfactants. This again adversely impacted our EBITDA by another 5 crores of rupees. Despite all these challenges, ladies and gentlemen, there were many bright spots. The structural uptick we have seen post-COVID as far as our India business is concerned continues with our volumes rising by 11% vis-a-vis the pre-COVID average. Barring any demand cutback or down trading on account of inflationary pressures, we remain optimistic. Though the supply-led volatility continues, we see the same improving quarter on quarter. Adaptation and experience will ensure better response and execution going ahead. We do believe the worst is behind us, and while this has been a difficult phase for us, we at Galaxy believe the executional challenges we are facing today are laying the foundations for our next decade of growth. We should see better quarters going ahead. I can confidently say this as the decline in EBITDA per metric ton has been arrested, with the Q3 EBITDA per metric ton coming in around 13,468 per metric tons versus 12,900 reported in Q2. We see this further improving towards stated band of 16 to 18,000 per metric tons in the coming quarters. Robust risk management system and adequate pricing revisions will ensure that the surging feedstocks and freight rates will be taken care of in the prices in the coming quarter. With the availability scenario improving, barring any global slowdown due to inflationary pressures, we are equipped to cater to the robust underlying demand. The phase-wise operationalization of our new capacities remains on track. The same will be completed by 1st April 2022, and this should again aid our performance in financial year 22-23. Ladies and gentlemen, to sum up, the current scenario reminds me of a famous quote by Joyce Meyer: "If you are strong enough on the inside, you can handle anything that comes at you on the outside." While the external scenario remains extremely uncertain, internally we are taking the necessary steps to enhance our performance, stability and delivery. We shall become stronger and more resilient to battle the challenges coming on our path from here on. Thank you, ladies and gentlemen.
So should we start the question and answer session?
Yes.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Participants who wish to ask a question may kindly press star 1 on your touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Rohit Sinha from Sunidhi Securities. Kindly proceed.
Hello. Yeah, thank you for taking my question, sir. So my first question is on the volume side. As we have seen India business recovering well, as well as the rest of the world has also done well in volume term growth. So in MH region, apart from this logistic issue, is there any other concern which is denting, and when we expect this volume to be on the positive side?
1 minute, Rohit. I think your voice is very not clear. So we are not very clear.
Okay.
Sir, I just request to not be very close to the handset, a little away.
Okay. Is it okay now?
Yeah, it's better.
Yeah. So as I was saying that since we have shown good volume growth in India business as well as in the rest of the world segment, just on this MH region, when apart from the container issues and logistic thing, what is there any other issue which has impacted the volume, and when we expect this volume to be on the positive side going forward? And is that the recovery would help us to regain our EBITDA per ton above 14,000 in coming quarters, 1 or 2 quarters?
Yeah, so first I'll answer your last question first. So obviously, very clearly, okay, we will go back to the band of 16,000 to 18,000 tons rupees per metric ton of EBITDA from the coming quarter. So that's what Shekhar said, that the worst is behind us. Okay, and then we have fortified ourselves well to be able to respond to the market situation. As regards your question with regard to the volumes in Ahmed, apart from the supply chain challenges that we had in terms of incoming raw material, majorly into our Egypt location, on the demand side, I think there was a listing on with regard to Turkey volumes. Okay, that was because of the local issues in Turkey in terms of the exchange and depreciation. Barring that, all the other markets, the demand is pretty robust. Within Egypt also, we are seeing that things are better. So we don't see anything significant moving other than this in terms of the demand side. And we do see demand coming back progressively from the coming quarters. But the challenge is in terms of the incoming supply chain has to improve better. We are already seeing some green shots. We expect that this would sustain.
Okay. So just in terms of our performance and specialty care segment, so do we see recovery in both the sides? I mean, what kind of traction we are expecting in both these segments?
See, on the specialty side, if you see the rest of the world has registered a very good growth. Despite the supply chain challenges that we had, we are also seeing in terms of our new products that the project that we're commissioning in Jagadia and Nebula in Tarapur. We do see that already good amount of traction in terms of the orders. So we are now working at full steam to be able to meet those particular demands, which already were delayed because of the project getting delayed due to COVID. And with regard to the preservatives component of our specialty segments portfolio, we have done exceedingly well, and we see this particular momentum continuing. Okay. And lastly, on the margin side, I mean, obviously this I believe would be worst. Would be over for us from here on. So just on the costing side, the 30-year coal prices are still the higher side, and I think VVF India has also filed for a sunset review on this alcohol, 30-year coal product. How we are, as you are seeing that one quarter lag is there for pass on. So do we expect from the all the contracts which were already how many contracts I would say has been revised and is yet to be revised, so that from the coming quarters there would be impact on the margin as well? So one of the things is that with regard to the increase in 30 alcohol prices have been very significant over the last 30 days, the way the crude palm oil has moved. So in terms of, we also got pretty experienced in terms of the way things are moving. So when we are getting into contracts, we are ensuring that appropriate calls are taken on the pricing and the contracts get tied up. With regard to the other minor feedstock costs that are there, those also have gone up significantly and have started stabilized at that high level. So we do not see any additional challenges moving forward.
So quarter 3, as you rightly said, was the worst because everything happened suddenly and significantly in terms of price increases over a period of 45 days, beginning September till almost end of October. Everything went up. You take crude petroleum, you took any minor raw materials, like you take caustic, you take sulfur. So everything moved up significantly. So those things are still higher, but they're stabilized at those high levels. So then once they stabilize, our ability to be able to manage the pricing is significantly superior. And that's what is happening.
Okay. That's it from my side, sir. I'll come back in queue. Thank you.
Thank you. Participants who wish to ask a question, kindly press star 1. The next question is from the line of Sanjesh Jain from ICICI Securities. Kindly proceed.
Yeah, good afternoon, sir. Thanks for taking my questions. Few questions. First, on the price hike itself, if I look at the gross profit per kg, we are already at 44 rupees per kg, which is probably among the highest. Does it indicate that we are able to pass on most of the raw material inflation? It is just a freight cost which is hurting us to reach the EBITDA per kg, or do you say there is a combination of both, so reaching EBITDA per kg will be incrementally easier? That's number one. Number two, on the volume side, though this quarter has been flattish, that's predominantly because of the AMAT. Do you think from here on the volume should increase with the supply chain easing out? I don't know what's the situation of ethylene oxide availability. I think that was one of the things which was hampering us in terms of volume growth. Because we have been consistently talking of demand being robust and we having a delayed supply. That means there is a good order book which is pending and the execution of which will accelerate. How should we see volume growth? These are the two initial questions.
Yeah. So Sanjay, first is the ethylene oxide situation has started improving from December. So as of now, we don't see any further cause of concern. Okay, so it has improved. That is one. Second is with regard to the question on the gross profit per kilo going up. We have been able, as we said, we've been able to pass on increases, but with a lag. So it's not that you're able to pass on increases the moment they happen. So that is a challenge we had, because as things go up month on month, it's also important that we are able to properly calibrate the price increases. So that's very important. So as we see moving forward, we do see that our ability to pass on the cost increases is pretty much good. With regard to the volume growth, we do see that things are improving, okay, and and we are already seeing that if you look at, say, Africa, Middle East, Turkey, rest of the world, you see the underlying demand is robust. But the supply chain challenges, if you look at, say, Latin America, if you look at North America, the local trucking and everything is a very significant challenge. Okay, and port clearance and local trucking. Europe is much better than North America and Latin America. Asia Pacific and AMET have improved quite a bit. So if this is the sort of traction we have, I think the volume growth should be picking up moving forward with the supply chain challenges easing.
And we are seeing the sign of supply chain challenges easing out, right?
Yeah, we are. So as I told you, in North America, the challenge is not to reach the ship reaching the port, but the major challenge is the internal transportation because of lack of availability of trucking. So wherever we have delivered duty-paid shipments, delivery terms of doing it at my customer's factory, there the challenges are significant. So if you look at Latin America is still pretty bad in terms of transit times and availability of freight space on the ships. Europe is much better. Okay, APAC has improved, and our AMET also has improved.
And then we said that we would take a price hike post-quarter, and we are already probably mid of February, 1.5 months into this quarter. Have we seen that flowing into our margins, and are we getting that early signs of recovery of the margin losses we have done?
Yes. Very clearly we are getting those early signs. Very clearly.
Very clearly, right?
Yeah.
Got it. The next question is on the new CapEx that we are hoping to commercialize from the 1 to 2. Did we see the utilization?
There's a disturbance. We couldn't hear you, friend. The question now.
No. Is it good now?
Yeah, it's better.
Okay. Just wanted to understand on the new product commissioning, the commercialization we are hoping from the Q1 FY23 onwards. Now, are we fully utilized the existing capacity? So is it fair to believe that the ramp up in this capacity will be much faster? Because the commissioning of these plants are happening with 6 or 8 months delay, right? So how is the situation of existing facility, and is it fair to assume that the ramp up in this would be earlier or slightly faster than what have we doing historically?
Yes, if you look at the plant that they commissioned in Jagadia, I think the existing capacities have been very well utilized. So there the ramp up will happen fast. But if you look at, say, our facility at Tarapur, which is in the process of commissioning, that actually is a mini plant more from a innovation-led requirement, and certain products that we're building in terms of certain market size capacities. There the ramp up will be slower than what it will be at Jagadia. But it will certainly be much better, but it will be slower than what it is at Jagadia.
Does the capacity issue hampered our growth in the specialty part, particularly in the preservative, now that we have been running preservative at a fairly high level for last 1 year? Do you think commissioning of this preservative plant in Jagadia will unleash some of the growth in the specialty? Will it be a fair assumption?
So we have, in terms of the way that we're growing our preservatives portfolio year on year, we have capacity sufficiently available to cater to this demand. That's why we have been able to, partake in the growth. With regard to there are certain new capacity we're setting up with regard to certain new age preservatives. That is where that commissioning will enable us to get in, a better product mix.
Got it. And last, on any future capex plans we are now doing, now that these planned ones are ready to commission, what is the plan for FY23 and FY24 in terms of product portfolio and capex?
Yeah, Sanjesh, the capexes will continue. The capexes will continue. We will continue to spend approximately 150 to 200 crores every year. At least we are able to see the visibility of this for the next 2 years.
Even this year, for the 9 months period, we have already made an outlay of around 150 crores.
Yeah, we have already made an outlay of 150 crores for this first 9 months.
And can you give some color on which are the products?
Sorry to interrupt, sir, but we do have a few.
This is just the last one, a follow-up one. Can you just give us what are the products which we are looking to expand in FY23 and 24?
This will be across all the ranges, both, but mainly specialty surfactants, mainly specialty products.
Got it. That's it from my side. Thanks for that.
Thank you.
Thank you. Participants who wish to ask a question, kindly press star 1. The next question is from the line of Rohit Nagraj from Emkay Global. Kindly proceed.
Yeah, good afternoon, sir, and thanks for the opportunity. So the first question is whether there were any orders which were postponed to Q4 due to force majeure and other reasons, and probably that may have some impact in terms of volumes and revenues for Q4. Thank you.
Firstly, Galaxy has never declared any force majeure. Okay? So the force majeure is not in our dictionary. Yes, we stand by our commitment. Certain orders will get deferred to this particular quarter in terms of fulfillment. Okay? So they will get fulfilled with a lag, primarily only because of the delay in in the arrival of the raw materials.
Right. Got it. So the second question, you mentioned about EO availability improving from December, but given that crude prices are increasing, again, EO prices also must be increasing. So whether we have the ability to pass it on, and secondly, same question on LA. In terms of the last 1.5 months, how the pricing movement for lauryl alcohol or lauryl acid has been, and whether again that will have an impact in terms of pass on with a lag of 2 to 3 months or so. Thank you.
So Rohit, See, passing on is a matter of only contract, okay? That will be done. But what is important is that whether this passing on to ultimate consumers is going to be tenable. Okay? Now that is where we need to be very clear in the sense that now the entire industry has to calibrate itself into ensuring that the final consumer is not impacted much. Otherwise, he is going to resort to cut back in his own consumption or down trading.
Right, got it. So just last clarification on volume growth guidance. Now, given that in 9 months we have done about 2% volume growth, what will be the volume growth guidance for FY22 and next year FY23, given the conditions that are prevailing now and probably the long-term orders in hand, whether we will again scale back to our previous guidance of 6 to 8% volume growth? Thank you.
Yes, we always aspire to be at our volume growth of 6 to 8%. That will be our attempt. And at this point of time, we are pretty buoyant about it.
Yeah, and for FY22?
FY22, I think we would possibly close at about 3% or so.
Sure. Thank you so much and best of luck, sir.
Thank you.
Thank you. Participants who wish to ask a question, kindly press star 1. The next question is from the line of Mayur Liman from Profit Mart Securities. Kindly proceed.
Thank you for the opportunity. I just want to ask what is the outlook for the next quarter? How do you see quarter 4 now, and what is your capex plan for next quarter?
Yeah, so also for next quarter, as I said, if you see the quarter 3 EBITDA per metric ton improved vis-a-vis quarter 2, and as we explained, moving forward, we expect for the next quarter the EBITDA per metric ton to be in the guided range of 16,000 to 18,000 rupees per metric ton. As regards capex for the next quarter, it's only what we are commissioning, as we said, one at Jagadia and one at Tarapur. And as we said, for the next year, we are having almost a capex of 150 crores, which is already committed.
Okay, sir. Thank you so much.
Yeah, thank you.
Thank you. If you wish to ask a question, kindly press star 1. The next question is from the line of Nakshita Mehta from Credent Info. Kindly proceed.
Good afternoon, and thank you for taking my question. So my first question is on the entire, the specialty chemical space. As in, almost all of the companies have been, affected due to the raw material prices, the input prices, right? So how do you see the situation right now, and how do you see the situation moving forward, say in FY23? If you can just give us an overview of the industry.
See, let us, we need to admit that there has been hyperinflation with respect to feedstocks across categories, across ranges. Crude has shot up and oleochemicals have shot up. And not just oleochemicals and crude, but all the derivatives. So we have seen hyperinflation with respect to the raw material prices in the last year. Similarly, we have seen hyperinflation with respect to freight rates across the world. Okay. So this is something that we expect it to continue till supply improves. Supply improves, which possibly should happen maybe in another about a year or year and a half or so. But in the short term, we do expect these high prices to continue, and we need to certainly manage this particular situation.
So a follow-up question on this: have we entered into any contracts with suppliers for the pricing, or how are we tackling this pricing issue?
See, there are no long-term contracts in these situations. Okay, there are only short-term contracts. In this volatile and uncertain situation, there are only short-term contracts, not very, very long-term contracts. No.
Okay. Right. So that was my one question. Right. Thank you so much, sir, and good luck.
Thank you.
Yeah.
Thank you. Participants who wish to ask a question, kindly press star 1 on your touchtone telephone. We request participants to kindly press star 1 to ask a question. We have the next question from the line of Dharmil Shah from Marcellus. Kindly proceed.
Yeah. Hello, sir. I just had a question on the specialty care product portfolio. What has been the product mix within the specialty care? Over the years, the mix for performance and specialty care has been somewhere around 65 to 35. But what about the product mix within the specialty care products? Has it any improved, or how do we see it moving forward for next 3 to 5 years?
No, as you know, our specialties consist of various categories. Almost all the categories are growing pretty well. That's what we would like to sum up. And we are setting up capacities to increase the capacities further. So that's a clear direction that we see in the coming few years.
Okay.
So we also know that we have had our new product that we introduced, which is our non-toxic preservative range, our GLI 21, which is a significantly superior mild surfactant. So these are all something for which we are setting up commercial scale capacities at Jagadia, and that is what is going to be driving the growth moving forward, in addition to our traditional preservatives, and mild surfactants.
Okay. And my second question was on accounting related. Also, the tax concession that we are enjoying for our Egypt subsidiary. So does it come with a sunset clause, or we will be having the concession lifelong?
No, the Egypt tax, this thing will continue to run.
Yeah, till Egypt, 25 years how many now?
It is for 25 years from the beginning.
Another 15 years.
So which means another approximately 14 years is left.
14 years.
Okay. Okay, sir. Thank you.
Thank you. To ask a question, kindly press star 1. The next question is from the line of Vijay Karpe from Branston Investments. Kindly proceed.
Thank you for giving this opportunity. What was our specialty care capacity at the end of financial year 2021, and where will this move to post the commissioning in April?
So can you repeat your question? I didn't get it properly.
My question is, what was our specialty care products capacity at the end of FY21, and what will it be post expansion in April?
So that will be a question that will be difficult to answer, because we have different products within the portfolio, and there are some products for which we are setting capacities where we have tested almost 90-100% of the capacity utilization. So post new commissioning, obviously the capacity utilization will come down, but that is to prepare ourselves for the future demand growth.
Okay. So according to your RHP, I think so, your specialty care capacity was somewhere close to 1,12,000 something. So what kind of number is it at the end of 21?
Oh, it's almost similar. So they've been it's almost similar.
Okay, and where will it go to in April?
Because see, this is all something that we do not like to divulge, because there are products where the capacity per se doesn't matter. It is a product that we have set up the capacity for. So these are pretty confidential in terms of what are the volumes or capacity increases that we are doing. So we would not like to mention that.
Okay. No problem. So we talked about our capex, and we'll be doing somewhere close to 150 to 200 crores for the next 2 years. I just wanted to understand what kind of capex we'll be doing post this in, say, suppose FY24, FY25, will we continue this similar rate?
Yes.
Yeah.
See, if you see our track record, we typically do 150 to 200 crores every year in terms of capex. So that trend will continue.
Got it. And the fatty alcohol prices were at $2,600 in Q3. Where are they now?
It is at almost 3,000, upwards of $3,000.
And lastly, what was our capacity utilization in the current quarter Q3, and also, if possible, for FY21?
I think for this 9 months, I think it was about 67%. And for the previous year, it was about 65%.
Yeah, and for the full year also, we'll be around the same 67-68%.
Okay. Thank you so much.
Yeah.
Thank you. Participants with questions, kindly press star 1. The next question is from the line of Rohit Sinha from Sunidhi Securities. Kindly proceed.
Yeah, thank you for the follow-up, sir. This is regarding our R&D segment. I mean, how much we are spending on R&D, and what is the strength, the team strength there?
The team strength of R&D is approximately 70 people, made up of a number of PhDs and masters. The R&D expenditure comes to approximately 40 to 50 crores every year.
Okay. So just wanted to understand, when we are looking at the new products and launching or targeting new products, so how is our approach in terms of finalizing the product? Is it from the customer side, or is it what we are trying to create a new product, or it is the overall, market demand which is moving more towards oleochemical or something like that?
Good. Yeah. So it is on many fronts. One is, of course, what we call consumer to chemistry. We see what are the consumer trends and innovate to respond to these consumer trends. Examples of these are what we did with respect to a number of mild surfactants as well as non-toxic preservatives. Secondly, we take certain specific innovation or development customized to certain customers, specific customers. Third is we have certain joint development programs with our customers. Fourth is in terms of what you talked about, the movement towards sustainability and green offers opportunities in terms of new products based on renewable and green feedstocks. So our innovation program gets driven through all these fronts. And so to sum up again, consumer to chemistry, joint development programs, customized work for specific customers, and the drive of sustainability and green.
Okay, fair enough. And one thing, obviously it is not easy to compare, but still if we compare ourselves, the global player, in terms of, again, targeting new products or targeting the addressable market, where and which company we should be most likely, you can say, compared to?
No. So this is, as we said, we are a global supplier to this global brands in the home and personal care segment. So we have projects on various fronts running with various customers in the home care and the personal care segment. So in some cases, some of them are very, very focused on home care. In some cases, they are very much focused on personal care. So it's a combination of approaches we have. So it is not that we pick and choose which customer. Ultimately, it has to be our whole focus on the home and personal care segment, which is what is important. This is that whichever customer are going to be interested in that and who would have, where we have a reasonable listing of succeeding, that's how we approach the projects.
Okay. And I'm just looking at any competitor we have to compare with.
See, we are, possibly our entire focus is on the personal home care industry. Possibly we are the only players, whereas all our competitors are in multiple industries. We are possibly the only company which is only focused on the personal home care industry.
Okay. That's it from my side. Thank you.
Thank you. Participants, if you wish to ask a question, kindly press star 1. The next question is from the line of Anubhav from MC Research. Kindly proceed.
Hello. Thanks for the opportunity. Couple of questions. One is, given the new price range for all the feedstocks, wanted to understand what is the raw material mix in terms of cost. How much is due to fatty alcohol and how much maybe due to crude derivatives?
So typically, say oleochemical derivatives contribute about 70% of our buying portfolio, and the balance is contributed by the petchem portfolio, which is linked to crude petroleum.
Okay, so the ratio remains the same.
More or less.
Okay. And sir, if you could talk about the supply situation from Malaysia and Indonesia with respect to fatty alcohol. How is the situation now in terms of production and all, and when do you think the prices will moderate?
So can you repeat the question, Anubhav? Again, I didn't get your question clearly.
Yeah. So it's basically regarding fatty alcohol supply from the source countries, Malaysia and Indonesia. So wanted to understand what is the situation there in terms of supply, and when do you think the gap between supply and demand can be bridged?
Yeah, so the suppliers, actually, if you look at it, we are strategic vendors for this, and the issue never has been in terms of their ability to produce and send it out of their factory. The issue has been the logistics in terms of the container availability, which, as we said, we are seeing improvement happening in the APAC region from the month of December, so things are getting much better. The issue never was in terms of the ability to produce. They have always been producing, but it was typically lying at their port for 2 weeks and 3 weeks and 4 weeks for want of space availability on ships. That was the issue. That is getting much better.
Okay. And if I put it this way, that compared to pre-pandemic times, how is the manufacturing of those fatty alcohol from Malaysia and Indonesia? Has it reached to similar level?
Yeah, they have.
Okay. Yes. Okay. And lastly, sir, you wanted to understand your capex focus for coming 2 to 3 years. You mentioned you will continue with the same run rate of 150-200. Which are the areas you would be looking at?
So I take it said, 150-200 crores are in terms of my existing products capacity enhancement in terms of the way the market demand is panning out. Second is in terms of the products coming out of the innovation funnel. So essentially on the 4 things that Shekhar spoke of in terms of products coming out of joint development arrangements with the customers, with regard to our approach to consumer chemistry, where we come up with the product solutions and molecules. The third is on sustainability agendas and both process related as well as product related. So this will typically be the sort of 5 verticals under which the investments will happen.
Okay. No, got it. Thanks so much.
Thank you. Participants, if you wish to ask a question, kindly press star 1. The next question is from the line of Nitesh Dhoot from Prabhudas Lilladher. Kindly proceed.
Good afternoon, everyone. So I joined a bit late. I'm not sure if this was already asked, but if you could just let me know that the recent restrictions imposed by Indonesia on export of palm oil and palm oil derivatives, how is it going to impact us?
See, first of all, the way we have understood, we've spoken to all our strategic partners in Indonesia. what we understand, okay, is that this particular thing, which was earlier only for palm oil per se, getting extended to palm oil derivatives as well, is something that is not tenable at all, because the local consumption in Indonesia is significantly lower than what they're expecting in terms of 20% being sold locally before they start exporting. So this is something that they are representing the Trade Ministry, and I think they are at very advanced stage. We do hope that better sense prevails and things would get resolved, okay, early next week. That's what is the update that we have from our strategic partners in Indonesia.
Okay. Thank you so much.
Thank you. To ask a question, kindly press star 1. The next question is from the line of Nakshita Mehta from Credent Info. Kindly proceed.
Good afternoon. Thanks for taking my question again. So I had a few follow-up questions. One is the volume growth is compared to pre-COVID level, and are we expecting it to stay the same, as in because in COVID season the home care and personal care has grown. So are we expecting that to remain at that level, or was it just the COVID rush?
Yeah. So one is the base has gone up significantly in terms of the products per se. That's because the hygiene habits of people post-COVID has changed irreversibly. Okay, so that is very clear. Now the growth will happen on that higher base. That's the way things are, and that is the fact world over. And that's what we are also experiencing.
Right. Okay. And the next question was on the environmental clearances. Have we received them for Jagadia and Suez?
Yeah, we have.
We have, right?
Yes.
Okay, yeah. That's it. Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
Yeah. Ladies and gentlemen, thank you very much. Once again, wishing all of you a healthy year ahead. See you again in the month of May. Thank you.
Thank you, and wishing you all a good day. Bye-bye.
Thank you. On behalf of Galaxy Surfactants Limited, that concludes this conference. Thank you for joining us. You may now disconnect.
Consent renew.